Disclaimer.
Oil just had its biggest weekly jump since 1983, 35%. A war is raging. The Strait of Hormuz is closed, and silver, your silver, is sitting at $82, not $120, not $100. $82. I'm going to show you exactly why that happened, and more importantly, what it tells you about what comes next. Because the answer is not what the financial media is saying. Stay with me. Picture two charts side by side. On the left, crude oil, a near vertical line rocketing from $68 to $92 in a single week, the kind of move that rewrites headlines and reshapes household budgets overnight. On the right, silver, a spike, then a cliff, then a slow bleed back to where it started. Same war, same chaos, completely opposite outcomes. If you own silver and you watched that happen in real time, you felt it in your gut. And you probably asked yourself the same question millions of Americans are asking right now. What is going on? Here's what actually happened, and why it matters far more than the financial news cycle is letting on. The moment Iran strikes began on March 1st, silver did exactly what history said it should. It surged from $83 all the way to $96.40, a $13 move in hours, the kind of war premium that makes precious metals holders feel vindicated. For about 48 hours, it looked like everything the silver bulls had been saying was finally coming true. Then the floor fell out. Silver collapsed 13% in 2 days, erasing every single dollar of that war premium, landing right back at $82 while oil kept climbing. Think about that for a second. A shooting war in the world's most critical oil corridor, and silver gave back 100% of its gains. Oil didn't give back anything. It kept going. So what is silver doing wrong, and what is it doing right? To answer that, you have to understand something that most casual silver holders never dig into. Silver has what analysts call a dual identity problem, and it's the single most important thing you can know about this metal right now. Gold is a pure monetary asset. That's essentially its only job. Store of value, safe haven, hedge against chaos. When war breaks out, gold goes up. When inflation surges, gold goes up. When the dollar weakens, gold goes up. There's no competing force pulling in the other direction. But silver? Silver lives two completely different lives at the same time. About 50% of all silver demand on Earth comes from industrial applications, the solar panels going onto rooftops across America, the EV batteries being assembled in Tennessee and Georgia, the AI data centers running server farms that now consume more electricity than entire cities. Silver is the most electrically conductive metal on the planet, and the modern economy needs enormous quantities of it. That sounds bullish, right? In a normal environment, it absolutely is. But here's the problem that war creates specifically for silver, and why no other commodity faces quite this same trap. The moment $92 oil flashes across every financial terminal on Wall Street, the recession alarm goes off. Because expensive oil doesn't just raise gas prices, it acts like a tax on every business and every household in America. It slows manufacturing. It squeezes margins. It makes investors look at industrial demand forecasts and start marking them down. And when industrial demand expectations fall, silver's industrial bid disappears right along with them. So at the exact moment the war premium should be lifting silver as a safe haven, the recession fear triggered by that same war is crushing silver's industrial value. You end up with two forces of roughly equal magnitude pulling in opposite directions, and the net result is that silver goes nowhere. Or worse, it falls. That's not bad luck. That's a structural design feature of the metal itself, and it's been hiding in plain sight for years. Now layer on top of that what happened in Washington on March 5th, because this is the piece of the puzzle most silver commentators are completely missing. That day, President Trump formally nominated Kevin Warsh to replace Jerome Powell as Federal Reserve Chair. If you don't know who Kevin Warsh is, here's what you need to understand. Markets do. Warsh is viewed as significantly more hawkish than Powell, meaning investors immediately began pricing in a tighter monetary policy environment going forward. A more hawkish Fed means a stronger dollar, and a stronger dollar is silver's kryptonite. The dollar index shot to a 5-week high of 98.0 on that single announcement. And silver? Silver dropped 9% that day alone. Most financial media called it profit-taking. That's the kind of lazy explanation that sounds reasonable on the surface and tells you absolutely nothing useful. It wasn't profit-taking. It was the market repricing silver for a world where the dollar stays stronger for longer than previously expected. Think about what that means for you if you hold silver right now. You're navigating 3 separate headwinds simultaneously. You have oil-driven recession fear hitting the industrial demand side. You have a dollar strengthening on Fed chair speculation hitting the monetary side. And you have a metal that, unlike gold, has no clean category to retreat into when both of those forces are working against it at the same time. That's why silver sat at $82 while oil climbed to $92. It wasn't irrational. It was a completely logical response to a very specific set of structural pressures. Here's what should give you pause, though. And I mean genuine pause, not panic. Every single one of those pressures is temporary and event dependent. The Warsh nomination creates dollar strength only as long as the market believes he'll actually take the job and pursue aggressive tightening. Oil's war premium depends entirely on how long the Hormuz disruption lasts. Recession fears are a forward-looking estimate, not a current reality. What doesn't change with any of those variables is the underlying supply picture for silver, and that's where this story gets genuinely interesting. Have you noticed how the loudest voices on silver tend to focus on the price chart and almost never on the production data? That's worth thinking about, because while the chart was doing its dramatic spike and crash routine this week, something completely different was happening in the physical silver market. Something that has been building quietly for 6 consecutive years, and just got a lot more complicated thanks to a decision made in Beijing on January 1st of this year. So silver is stuck between two forces pulling in opposite directions. But here's what nobody is telling you. One of those forces is about to disappear, and when it does, the math changes completely. March 5th, 2026. Silver is having its worst single day of the year, down 9%, sitting at its weekly low of $82. Retail investors across America watching their portfolios bleed and asking themselves whether they made a mistake. Message boards are lighting up. The sentiment is ugly. And right in the middle of all that noise, a single institutional order hits the silver futures market for $1.3 billion. Not $100 million, not half a billion, $1.3 billion on the worst day of the year, at the exact moment the panic was loudest. Now, institutions make bad calls too. Nobody's infallible. But when you see that kind of conviction at that specific moment, the first question any serious investor should ask isn't, are they right? The first question is, what do they know that the people selling don't? Here's what they know. The Silver Institute, which tracks global supply and demand more comprehensively than any other organization on Earth, confirmed earlier this year that 2026 marks the 6th consecutive year of global silver supply deficit. Let that land for a second. 6 years in a row where the world has consumed more silver than it has produced. The shortfall this year alone sits at 67 million ounces. To put that in physical terms, imagine a cube of silver the size of a 3-story building. That's roughly how much the world needs but cannot find in current production. And this isn't a new development that the market hasn't had time to price in. It's been building since 2021, compounding year after year, and yet silver spent much of that period trading sideways or declining. Markets can ignore structural realities for a long time. They cannot ignore them forever. But the supply story got significantly more complicated on January 1st of this year. And this is the part that should have been front-page financial news and somehow wasn't. China placed silver under export license controls, the same regulatory category it uses for rare earth metals. If you followed the rare earth story over the past decade, you know exactly why that matters. Rare earth export controls gave China enormous geopolitical leverage over industries that depended on those materials, and the process of finding alternative sources took years and cost billions. Silver is now in that same box. China is a major secondary supplier of silver to global markets, and those supply flows just got a gate put on them. The license requirement doesn't mean China stops exporting silver entirely. It means China now controls the valve. They decide how much comes out and when. For a market already running a 67 million ounce annual deficit, losing reliable access to a key secondary source isn't a footnote. It's a structural shift. So when that institutional player dropped $1.3 billion into silver at $82 on March 5th, they weren't betting on a chart pattern. They were betting on arithmetic. A 6-year deficit doesn't reverse because oil prices spiked or because a Fed chair nomination strengthened the dollar. Those are price events. The deficit is a physical reality. Industrial users need silver to build solar panels and EV batteries and AI infrastructure, and the ground simply isn't producing enough of it. At some point, the price has to reflect that reality. The only question is when. Which brings us to the pattern that Gold Silver's lead analyst quietly flagged in late 2025, and why the people who noticed it aren't talking about it casually. Pop quiz. When was the last time silver posted clusters of consecutive weekly all-time highs before a historic run? The answer is 1979, and here's why that matters beyond surface-level chart comparison. In 1979, silver went through a period of compressed grinding consolidation, weeks where it made new highs, pulled back, made new highs again, pulled back again, each time frustrating holders who expected the move to just take off cleanly. That cluster pattern, those consecutive weekly highs followed by sharp mid-cycle corrections, was the technical fingerprint of a market that was coiling before a massive release. What followed was a 700% surge into 1980, one of the most dramatic commodity moves in American financial history. Now, and this is critical, nobody is telling you 2026 is 1980. Markets don't photocopy history. Anyone promising you a specific repeat of a 45-year-old move is selling something. But here's what the data objectively shows. That same cluster pattern of consecutive weekly all-time highs appeared in late 2025. And the correction silver is experiencing right now, this ugly, demoralizing, why isn't it working pullback, mirrors the mid-cycle corrections that appeared inside that 1979 pattern before the acceleration phase began. The structure isn't proof of anything, but it is a data point that serious analysts track, and it's a data point that lines up uncomfortably well with everything else we've been discussing. Think about what we've built here so far. You have a metal with a dual identity that temporarily suppresses its price during the exact geopolitical conditions that should be driving it higher. You have 6 consecutive years of supply deficit that the market has largely ignored. You have China locking the secondary supply valve on January 1st. You have a technical pattern that last appeared before the most dramatic silver run in modern history. And you have institutions, not retail, not Reddit, not newsletter writers, institutions placing billion-dollar bets at the moment of maximum retail panic. What does that combination tell you? It tells you that the people with the most information and the most capital are not reading this correction as a broken thesis. They're reading it as a buying opportunity created by temporary event-driven pressures, the kind of pressures that eventually resolve one way or another, while the structural fundamentals underneath keep compounding. Here's what you still need to understand, though, and this is the piece that actually lets you put a number on all of this. Because the fundamentals are strong is something people say about investments right before they lose money waiting for the market to agree with them. And what separates informed holding from wishful thinking is having a specific, mathematically grounded framework for what silver should be worth and why. And there is exactly one number that gives you that framework. Most silver holders have heard of it. Very few have actually sat down and run the math on what it means at today's gold price. When you do, the results are the kind of thing that make you want to check your work twice. The gold-silver ratio. If you've been in precious metals for any length of time, you've almost certainly heard those 4 words. But there's a difference between hearing something and actually understanding what it means in dollar terms right now, at this specific moment in history. So let's do the math together. Not abstractly, not theoretically, but with the actual numbers sitting in front of us today. Because what that ratio is currently saying about silver's price is the single most important thing any silver holder can know, and most people have never had it explained to them simply and honestly. Here's the concept. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. That's it. Right now, gold is trading around $5,300 an ounce. Silver is at $82. Divide those two numbers and you get approximately 65 to 1. 65 ounces of silver for every 1 ounce of gold. Now, on its own, that number doesn't tell you much. What makes it meaningful is the historical context. Specifically, what that ratio has looked like during every confirmed precious metals bull market over the past 4.5 decades. In 1980, at the peak of the last great silver run, the ratio compressed all the way to around 16 to 1. In 1998, during a powerful mid-cycle silver rally, it hit 40 to 1. In 2011, at the height of the commodity supercycle, when silver touched $50 an ounce, it reached 32 to 1. And even during the sharp but brief COVID-era precious metals spike in 2020, the ratio moved from over 100 to 1 all the way down towards 65 to 1 in a matter of months. The pattern across 4 decades is consistent enough to be instructive. When silver is genuinely participating in a bull market, when both its monetary and industrial personalities are firing at the same time, the ratio moves toward 30 to 40 to 1. Not because an economist decided that's where it belongs, but because the dynamics of a smaller, more volatile market amplify silver's moves relative to gold when the conditions align. So, what does 65 to 1 tell us? It tells us that right now, by historical standards, silver is deeply undervalued relative to gold, not based on sentiment, not based on a thesis, based on a ratio that has mean reverted 3 times in modern history and is currently sitting near its most stretched level of this entire bull cycle. Now let's run the actual arithmetic, because this is where it stops being abstract and starts being the kind of math you can write on a napkin. If gold stays exactly where it is, $5,300 an ounce, not a single dollar higher, completely frozen, and the ratio simply returns to 40 to 1, which is the conservative end of historical bull market norms, silver's implied price is $132. That's a 60% move from $82 without gold doing anything at all. If the ratio moves to 30 to 1, still well within what we've seen 3 separate times since 1980, silver is at $176. And if gold continues its own trajectory while the ratio compresses, you get into the territory that Bank of America's head of metals research, Michael Widmer, has been publishing in formal research notes, a 2026 price target of $309 per ounce. Here's what you need to understand about that $309 number, because the way it gets discussed, when it gets discussed at all, tends to make it sound like an outlier fantasy from someone who's permanently bullish on metals. It isn't. Whitmer's math is not built on silver doing something extraordinary or unprecedented. It's built on silver doing something it has already done 3 times, returning to a normal historical relationship with gold, while gold continues the trajectory it's already on. The $309 target is what happens when you apply ratio compression to a rising gold price. It's not a prediction that requires a new paradigm. It requires 2 things that have both happened before, happening again at the same time. That's a very different kind of forecast than silver goes to the moon because the dollar collapses. What's remarkable is how little coverage this has gotten in mainstream American financial media. We spent weeks analyzing every Fed statement word by word. We built entire news cycles around a 2% move in the S&P 500. And a major Wall Street bank's metals research desk published a $309 silver price target backed by 4 decades of ratio data, and it barely registered. That gap between what institutional research is saying and what everyday Americans are hearing is exactly why videos like this one exist. But intellectual honesty requires us to look at both sides of this story, because having a mathematical framework for where silver could go is not the same as knowing when it gets there. And for real people managing real savings, timing is not irrelevant. So let's walk through the 2 scenarios that are most likely to play out from here, and what each one means for silver holders practically. Scenario A. The geopolitical situation in the Middle East finds some kind of resolution over the next 4 to 6 weeks. Not necessarily peace. Geopolitics rarely resolves cleanly, but a ceasefire, a negotiated corridor reopening, enough of a diplomatic framework to take the Hormuz disruption off the immediate crisis table. What happens to silver in that world? Oil pulls back from $92 toward the low 70s as the war premium deflates. Recession fear, the force that was crushing silver's industrial bid, begins to ease as forward demand forecasts stabilize. The dollar, which surged on both war-driven safe haven demand and Kevin Warsh's hawkish reputation, loses a meaningful portion of its tailwind. And suddenly, the 2 forces that were simultaneously suppressing silver both begin to fade at the same time. That's when the underlying story, 6 years of supply deficit, China's export controls, institutional accumulation at $82 takes over as the dominant narrative. In that scenario, silver's path toward $100 to $120 by the second quarter is not a stretch. The structural ceiling that war created disappears, and the physical floor that years of deficit built holds firm underneath it. Scenario B is harder to sit with, but you need to understand it clearly. The Hormuz disruption persists longer than markets expect. Oil stays elevated deep into the spring. Inflation, which had been cooling, reaccelerates as energy costs work their way through every supply chain in our economy. The Federal Reserve, whether under Powell finishing his term or Warsh taking over with his hawkish mandate, delays the rate cuts that markets had been pricing in for 2026. The dollar holds strong. In that world, silver grinds. It consolidates in the $75 to $85 range for another 60 to 90 days. It tests the patience of everyone who bought at $96 during the initial war spike. The headlines get discouraging. The message boards get ugly again. But here's the critical thing that doesn't change in scenario B. And this is what separates an informed holder from someone who panic sells at the worst moment. The deficit is still 67 million ounces. China's export license controls are still in place. The cumulative 6-year shortfall keeps compounding week by week, month by month, regardless of what the dollar index or the Fed funds rate is doing. Physical silver doesn't care about financial conditions the way paper assets do. At some point, and the Silver Institute's own data makes this mathematically inevitable, the gap between what the world produces and what the world consumes forces a price response. The deficit scenario doesn't require a perfect macro environment. It just requires time and the basic laws of supply and demand to eventually do what they always do. What's worth appreciating about both scenarios is what they have in common. The structural bull case for silver remains intact in either one. The difference is weeks versus months, $100 by spring versus $100 by summer. That's a meaningful timing difference depending on your personal situation and your liquidity needs, but it's not a difference between the thesis being right and the thesis being broken. Now, what should you actually do with all of this? That's a question only you can answer because it depends on your timeline, your overall allocation, your tax situation, and your personal financial goals. Nothing here is advice tailored to your specific circumstances, and anyone who gives you a blanket, buy silver now, or sell everything, without knowing your full picture, is not actually serving your interests. What this framework gives you is something more valuable than a trade recommendation. It gives you the ability to evaluate the situation yourself with real data, rather than reacting to a price chart and a headline. Here's what we know, stated plainly. Silver spiked and crashed this week for structural reasons that are temporary and event dependent. The underlying supply deficit has been compounding for 6 years and just picked up a significant supply side complication from Beijing that has no quick resolution. Institutions placed the largest single-day silver bet of the year at the moment of maximum retail panic. The gold-silver ratio sits at historically stretched levels that have compressed 3 times in modern history, and that compression alone, with gold going nowhere, implies silver prices dramatically above $82. And Bank of America's Metals Research Desk has a $390 price target in published public research that almost nobody in mainstream American financial media has taken the time to explain to the people who actually own silver. You don't need silver to be perfect right now. You need to understand what you own and why. The war didn't break the silver thesis, it just temporarily paused it. The deficit is still there. China's lock on supply is still there. And right now, institutions are buying at $82 while retail is selling. Make of that what you will.